Welcome to the Deep Dive. Today we're really digging into Tuesday, November 11th, 2025. What a day in the markets. It wasn't just volatile, it felt fundamentally fractured.
Fractured is a good word, maybe even split personality. It was definitely one of the most divergent trading sessions we've seen all year.
Right.
And that divergence is the key. If you look at the afternoon wrap-up sources, the market literally seemed to tear in two. You had this massive rally in old economy stocks, just pure euphoria driven by relief.
And on the other side.
Real pain, genuine contagion hitting those big tech names, especially the AI stocks that have been, leading everything for 2 years.
So our mission today is to unpack that schism, right? Get into the causes, look at the market internals, and try to make sense of it for you.
Exactly. Translate the noise into something actionable.
And the central conflict, it's almost hard to believe. The Dow Jones surging, 600 points at its peak? Just this huge risk-on move.
Yeah, fueled by this collective sigh of relief, which we'll get into.
But at the same time, the NASDAQ gets hit with actual fear, like proper risk-off selling, specifically hammering artificial intelligence.
It signals a really powerful rotation happening under the surface. Could be painful for some.
It felt like a real tug-of-war.
Definitely. And the strength of that rope, that tells you a lot about what might come next.
Okay, let's start with the headline numbers, the closing figures. Because just looking at those, you might miss the drama underneath. How did the indexes capture this tale of two tapes?
Well, the S&P 500, the broad market benchmark, it kind of showed that middle ground. It eked out just a tiny gain up 26 points, so plus basically 0.38%.
Barely positive.
Right, and it spent the whole morning in the red. It was clearly caught right in the middle of these two opposing forces.
So what about the extremes then? The Dow.
The Dow was the undisputed star of the show. Rallied huge, 539 points up. That's 1.1%. Getting close to a new record high, actually.
And that was broad-based.
Very broad. Cyclicals, value stocks, the whole sort of old economy complex was celebrating.
And the flip side, the NASDAQ.
That's where the pain was. The NASDAQ composite closed down 0.4%. It led the losses for the day, really confirming where that selling pressure was concentrated.
Okay, so that kind of divergence doesn't just happen. There have got to be two really strong opposing stories driving this. Let's tackle the good news first. What was this Washington tailwind lifting the Dow?
It was basically a massive sigh of relief from Washington, D.C. The main driver was news that the government shutdown, the longest ever, 42 days, is finally ending.
Finally.
Yeah. The Senate approved the deal late Monday. The House vote is expected at any minute now, and the president's indicated he'll sign it. So it's pretty much a done deal.
Okay, that removes a huge cloud of uncertainty, stops the economic bleeding from things like, flight delays and whatnot.
Yeah.
But is the market maybe getting ahead of itself here? Betting on cyclicals before the data actually confirms things are okay?
That's a really sharp point. Yes, the market is forward-looking. The relief isn't just about the immediate disruptions ending, although that helps confidence.
Right.
The crucial bit for investors and the Fed is that the data blackout ends. Key inflation reports, employment numbers, we haven't had them. The Fed's been, as the source material puts it, flying blind.
Ah, okay. So getting that data back means the Fed can actually make informed decisions, especially heading into that critical December meeting.
Exactly. It restores some predictability. So the market's basically betting that the U.S. economy avoids this self-inflicted wound and that momentum's coming back.
So that sparks this big rotation into the economically sensitive stuff, cyclicals, value names. You mentioned healthcare and industrials lit up.
Precisely. That's the resolution story in a nutshell.
Okay, now for the dark side. The NASDAQ. Why did AI stocks get hit so hard? You mentioned NVIDIA specifically. What turned selling into actual contagion?
It was a nasty double whammy, really shook confidence in that whole AI valuation narrative. First catalyst, kind of a bell-showing moment.
Oh.
NVIDIA, the absolute poster child of the AI boom, dropped 3%. Why? Because the Japanese tech giant SoftBank revealed they'd sold their entire stake last month. We're talking $5.83 billion worth.
Wow, their entire stake. From a major player like SoftBank?
Yeah, that signals massive profit-taking from someone very sophisticated. It definitely spooked market, made people wonder if, maybe the peak is in or close.
What's the big signal? Oh, what was the second hit? You said it was maybe more fundamental?
It came from a company called CoreWeave, ticker CRWV. They're an AI-focused cloud provider and, importantly, a huge customer of NVIDIA's chips.
Right, I remember.
They plunged over 14% today. They reported a delay in building out a data center, which means they're going to miss their Q4 earnings expectations.
Ouch. So that's the canary in the coal mine.
Pretty much. It's the first really hard evidence that this spend-at-all-costs frenzy on AI infrastructure might be hitting, I don't know, logistical hurdles, maybe financial limits.
So you have one big investor cashing out, questioning the valuation, and then a key customer stumbling, questioning the actual pace of spending. Why did that ripple out so widely?
Because the whole AI sector has been trading on this promise, this assumption of just relentless spending growth. The SoftBank news hit the valuation story. The CoreWeave news hit the execution story.
Got it.
Put them together, and it sent shockwaves right through the AI supply chain. We saw other key AI infrastructure stocks, think Micron, Oracle, Palantir, they all fell more than 2% just in sympathy. That's your contagion.
Okay, this tale of two tapes idea seems solid. To really prove it, though, we need to dig into the market internals. Let's start with the VIX, the fear gauge. Now, wait a second. Dow soaring, S&P slightly green. Surely the VIX went down.
You'd think so, wouldn't you? But no, the VIX actually closed up 0.37 on the day, finishing at 17.97.
Up on a day like today.
Exactly. That's a major bearish divergence. It's a huge red flag.
What does that tell you?
It tells you that even though most of the market was feeling pretty good, investors were actively, maybe even frantically, buying downside protection, put options specifically on those big, heavily weighted tech stocks.
So the fear in NVIDIA and its peers just overwhelmed the calm everywhere else.
Pretty much. The demand for protection in that narrow leadership group was intense enough to lift the whole VIX index. It's statistically quite significant when you see that kind of split.
Okay, so VIX up is bearish divergence. What about market breadth, the advanced decline line? Did the average stock have a better day?
Oh, absolutely. Breadth was incredibly strong, actually. Depending on the exact count, somewhere between 72% and 75% of all stocks in the S&P 500 finished positive. That's around 360 companies gaining ground.
Wow, okay, so that confirms the theory perfectly.
Yeah.
The average stock did great, but the S&P 500 index itself barely moved because those few losing stocks, the big AI names, carry such enormous weight.
Textbook example of strong breadth being masked by weak leadership at the very top in terms of market cap.
But there's always a but, isn't there? There's a wrinkle in that nice breadth story when we look deeper, right? Talk about the new 52-week highs versus lows.
Yeah, this is where you see the underlying fragility. Despite the Dow rally and the decent breadth, we actually saw 172 stocks hit a new 52-week low today.
172 lows. How many highs?
Only 110 hitting a new 52-week high.
Uh-oh. That's not good. More lows than highs on a day the Dow surged over 500 points.
It's a major internal divergence. In a really healthy, broad rally, you want to see new highs swamping new lows. The fact that more stocks are still breaking down suggests the market's foundation isn't as solid as the Dow might make you think. The rally isn't lifting all boats, still some damage underneath.
Okay, let's follow the money. Sector performance should really paint the picture of this rotation. Where did the cash actually flow today?
It's almost a perfect mirror image of the divergence. 10 out of the 11 S&P sectors finished in the green. Guess which one was red?
Has to be technology. XLK.
Bingo. Technology was the only loser dragged down by that AI contagion we talked about. The money flowed pretty much everywhere else, specifically into old economy and what you might call defensive value.
So who are the big winners sector-wise?
Healthcare really stood out. It's kind of a defensive play, but also has value characteristics right now. We saw strong moves in Merck, up 4%, Amgen up over 3%, Johnson & Johnson up over 2%.
Okay, defensive value. What else?
Industrial surged. That's your pure cyclical bet on the shutdown ending and economic activity picking up. And interestingly, even consumer staples saw inflows.
Staples, like soap and cereal companies. They've been dogs for years.
Exactly. But today, investors were fleeing the high-flying, high-risk tech names and looking for safety in just bare necessity stocks, a real flight to perceived safety, even into sectors that have underperformed for ages.
Fascinating rotation. Okay, let's drill down to some specific stock movers that were driven by news today. Paramount Skydance, PSKY, rocketed up 8.4%, but didn't they miss on earnings?
They did. Their first report since the merger, missed on revenue, missed on profit, but the market completely looked past the rearview mirror.
So why the huge jump?
It was all about the future. New management came out with a really aggressive plan to cut costs. They jacked up their synergy target to $3 billion. So investors basically said, okay, we ignore the past, we're betting on this turnaround story. A pure forward-looking bet.
Got it. Turnaround play. Then there was FedEx, FDX, up 6%. That sounds like a macro story.
Absolutely. FedEx is a classic economic bellwether, right? They actually increased their profit forecast for the holiday season.
Oh, really? Despite everything?
Yep. And that was seen as a huge vote of confidence in the U.S. consumer, in the economy bouncing back, tying directly into that optimism about the shutdown ending.
Perfect link. And on the losing side, we have to mention NVIDIA again, down 3%. Just to recap, that SoftBank exit, the CoreWeave Contagion, it really hit the narrative hard.
It really did. I think for the first time, investors are seriously asking questions about just how sustainable that breakneck pace of AI infrastructure spending really is. Is there a limit? Are we hitting it?
Big questions. Now we need to zoom out. Today was Veterans Day, which had a massive impact on the broader market context, didn't it? What happened across other assets?
Yeah, this is maybe the most critical piece of context for today's equity move. Because it was Veterans Day, the U.S. bond market was completely closed.
Right. No bond trading at all.
None. Which means this entire violent rotation we just described, Dow up, NASDAQ down, value over growth, it all happened in what you could call a ghost market.
Yeah.
It happened without the bond market getting its vote.
The bond market's vote on inflation, on growth expectations.
Exactly. So tomorrow, when the cash bond market reopens, that is going to be the real test of whether today's equity rally, especially in cyclicals, has legs.
Huge point. Okay, so bonds closed. What about the U.S. dollar?
The dollar index, the DXY, it actually pulled back about 0.25%, down to around 99.38.
Which makes sense.
If it's risk on. The shutdown resolution removed one key reason to hold the dollar as a safe haven. So investors felt comfortable selling the dollar and moving into riskier cyclical assets elsewhere, classic risk-on move.
Okay, but then gold was also up. Closed around $4,138 an ounce. That seems a bit contradictory. Selling the safe haven dollar but buying safe haven gold.
It perfectly highlights the split personality of the day. Yes, gold got a mechanical lift from the weaker dollar. That's part of it.
Sure.
But more importantly, I think investors were buying gold as a hedge. A hedge against what? Against a potential tech-led market correction, given those cracks we just saw in NVIDIA and the AI leaders. So they're participating in the cyclical rally, but hedging their bets with gold in case tech really rolls over.
Hedging the euphoria. Makes sense. And finally, crude oil. WTI was up nicely.
Yeah, WTI crude surged about 1.6%, back over $61 a barrel. This is probably the purest shutdown ending trade you could find today. Well, crude prices had been weak on worries about oversupply. Today's jump basically reverses that. It's a direct bet that with the U.S. government back online, economic activity will pick up and demand for energy will rebound. Pure growth optimism.
Okay, so today really sets the stage for a critical next 24 hours. What do we need to watch tonight and tomorrow to see if this rotation sticks?
Tonight, after the bell, the big one for tech traders is the AMD Financial Analyst Day. Talk about timing.
Right. After NVIDIA gets hammered.
Exactly. All eyes will be on AMD, NVIDIA's chief competitor. Can they steal the narrative? What do they say about AI spending? Their commentary is going to set the tone for tech. Tomorrow, no question. We also get earnings from Alcon, Amdocs, and Hyliion tonight.
Okay, AMD is key tonight. What about the docket for Wednesday? Sounds like it could be massive now that the shutdown's over.
It's huge. Sort of a triple threat. First, as we said, the bond market reopens. We get a 10-year note auction, too. That's the acid test for today's rally.
Test number 1, bonds.
Test number 2, the Fed. We get a whole parade of Fed speakers, Williams, Waller, Bostic, Collins. It's their first real chance to react publicly to the shutdown ending and the new fiscal picture. What do they signal?
Test number 2, Fed reaction.
And test number 3, more tech earnings. Crucially, another semiconductor firm, Global Foundries, GFS, reports before the market opens, along with TransDigm, TDG. Will GFS confirm the CoreWeave weakness or push back against it?
And you also mentioned oil data.
Yeah, the OPEC monthly report and the usual APIA inventory data will tell us if today's crude rally was just a one-off or if there's something more sustainable there.
Okay, so pulling this all together after a really turbulent day, what does this mean for you, the investor, looking at your portfolio tonight?
Well, I think the main takeaway is that this wasn't just noise. This was a high-volume, pretty violent rotation. It really felt like it could be a passing of the baton. From that magnificent 7 AI-driven trade, which, let's face it, some strategists think is looking pretty late stage over to the more traditional old economy, blue chips, healthcare, maybe even staples, the stuff that's been left behind.
So the big question everyone needs to ask themselves tonight is pretty simple, isn't it?
I think so. Was today just a one-day head fake? driven by relief about the shutdown? Or is this the start of the real great rotation that value investors have been waiting and waiting for?
And the answer depends on.
The answer really lies with those bond traders tomorrow morning and what that parade of Fed speakers tells us. Their collective vote is likely going to dictate market direction for, well, probably the rest of the quarter.
What a fascinating setup. Thanks for walking us through that incredible market divergence today, connecting all those dots between the headlines, the internals, and the cross-asset moves. Really appreciate you joining us for this deep dive.